Good morning and welcome to my post-election portfolio analysis. That's a mouthful. Well, today's announcement of a Labour government brings no real surprises. At the point of writing this article, UK and global markets are relatively unaffected, and they've seen this as a likely outcome for many months. Sometimes predictable is good, especially when it comes to the stability of our clients' investment portfolios. So, what's our early analysis and how do we think the new government will likely impact upon your investment portfolio in these early days? I thought it might be handy to deal with this as a bit of a timeline of what we might experience in the coming months. Now, I could be so wrong here, but here's a bit of observational guessing. So on the 9th of this month, the PM will attend, or the new PM will attend, a 3-day NATO International Summit in Washington. And this will be a great opportunity for Keir Starmer to try and soothe the allies that the UK continues to be committed to global security. But it also starts that process of him trying to build solid relationships that the Labour government will very much need to get that economic growth. On the 18th of this month, the new PM then chairs the European Political Community in Oxfordshire. And again, this will allow him to try and build those valuable relationships. Whilst Sir Keir is wooing potential trading partners and allies, his new ministers will be busy abolishing the Rwanda plan, reversing the onshore wind farm bans, reviewing UK military capabilities, and trying to negotiate with those junior doctors. Watch out as well for a huge reworking of the National Planning Policy Framework, where the government will target councils to build more homes. On the 17th of July, we get the King's Speech, and we would expect to see taxpayer-funded bodies, third-party bodies such as the Office of Budget Responsibility, being handed more power. This is designed to bring along all those civil service and regulatory bodies who've been at odds with the UK government for so long. In addition, we would expect to see the Make Work Pay agenda rolled out and look out for GB Energy as well, based in Scotland, as the new government will be hoping that this can offset the potential exodus of UK-based energy companies due to a sustained planned higher taxation. We come into August. Now, the 1st of August is big. That's the Bank of England Monetary Policy Committee meeting. Expect to see a potential rate cut here, or at the very least a change to the bond selling programme, which will be designed to kickstart the economy in line with Labour's plans. Now, Mr Sunak and co are just going to feel so aggrieved when they see this, but the writing's on the wall for looser monetary policy from the Bank of England. In our opinion, they should have moved sooner on this, and it may already be too late to prevent deflation. At the same time, we expect to see lots more lords being appointed by the Labour government to try and boost their chances of getting legislation through. September, well, that's conference season. Very simply, Labour will be using the line of undoing 14 years of economic stagnation, whilst the Conservatives enter a massive punch-up. October, well, that's big because the new Chancellor, who we expect to be Rachel Reeves, will deliver her first budget. That's if she doesn't do something sooner. Now, at this point, we know that she's going to look to tax non-domiciled residents in the UK. She's going to probably seek to place VAT on private school education fees, and she will look to expand the windfall tax on energy companies. However, in honesty, this isn't going to be enough to really move the dial in terms of instant rebalancing of the books for the new government. And this is where we expect to possibly see those wealth taxes. So let's try and talk about those briefly. I think there could be capital gains tax changes and potentially changes to pensions. Now look, it's just guesswork, okay? But we think that capital gains tax on investments could get realigned to income tax levels. So a basic rate payer at the moment only pays 10%. But that could rise to 20%, and a higher rate at the moment, well, they only pay 20% on investments, but that could go to 40%. And that begs the question, will second home sales be subject then to 28% and 48%? Well, anything's possible. The government are unlikely to be a friend of any property landlord or second home owner, so we are bracing for potential big hits in this area. There is a chance as well that Labour go after the pension pots again, and we see that lifetime allowance resurface, probably with a break for medical professionals, but I don't know how they'll arrange that. The other thing is to see a pushback against pension freedoms, which of course George Osborne brought in. That worries me. They may well push back the personal pension retirement age, reduce the tax-free cash, or link it to specific annuity requirements. None of these make me very happy. The other area that we could see Mrs Reeves seek to correct is underinvestment in UK companies by large pension funds. Now, the amount of large pension funds that barely invest in the UK stock market has become quite bewildering and something of an act of sort of domestic self-harm. Any intervention here could really make a difference. So, to sum this all up, I thought, let's go for a film title. How about The Good, the Bad and the Ugly? I know. Right, here we go. The Good. According to Darren, there can be no doubt that the governing of our country has become fairly dysfunctional over the past 5 years. I'm being kind. Too many factions have fought one another, and ultimately government is only as good as its administration. Now, we're hopeful that the civil service departments and third-party taxpayer-funded bodies will now seek to align themselves to the government's vision. This should create a period of stability, which usually helps portfolios. If the new government can come up with bold plans to force large pension funds to back UK companies, we could see a boom time return for UK equities and a real boost to our own economy. This could really help our medium and higher risk portfolios. The likely interest rate cuts and structural changes by the Bank of England should really help lower risk portfolios by lifting bond prices. We've been waiting an awfully long time for this. What about the bad? Only my view. I'm just thinking the new Labour government inherits a really tax-heavy setup here. I mean, this massively suits them, doesn't it? The promises from Mr Sunak to cut taxes will be lost in the ether. Whilst the UK cupboard is bare, we may not need to see huge rafts of tax rises to restock it over time. However, I think it will be very hard for the new government to truly stimulate the UK economy with such a long-term high tax burden. Property landlords and small employers may also be concerned about their property or business investments, with the potential for a pincer movement of higher taxes coupled with tighter regulations. Smaller private schools may well close, as they've already been struggling to compete with public sector teacher pay. And those with personal pension pots in their 50s may feel very nervous about the potential tax raids that they could experience. Finally, those pesky non-DOMs may well just up sticks and take their money elsewhere. Now, whilst it's politically attractive to target those who are not contributing their taxes, the economic weight of the big spenders withdrawing is obviously a risky counter problem. In the case of our client portfolios, we've already been manoeuvring away from the CGT arena as much as we possibly can, and we haven't held property within the portfolios for over a year, and we're already quite UK equity heavy. So we'll continue to keep our ear to the ground and carefully advise you all as we get the facts in regards to any potential pension changes and CGT dangers. You know me, I love making a video. So to conclude, the ugly. Well, Sir Keir, obviously he's not ugly, love him or loathe him, he inherits a pretty tough gig actually. The UK is in a lot better shape than it was a year ago, but still there are structural changes required which need careful navigation. Everything's underpinned by his team's promise to grow the economy. If this doesn't happen, he won't be able to blame the Conservatives forever. For now, he's got some breathing space, but ultimately he will fear his deputy and the trade unions turning on him if his plan doesn't work. I believe we've got a period of potential calm ahead of us now, barring any global pandemics or acts of war. There is the opportunity for investors to quietly pick up some nice profits here, and careful tax planning will be critical. alongside diligent diversification and monitoring to get the very best out of a new era. I'm quite calm about the coming 18 months, and we're absolutely on it in terms of watching for developments as they come. And if you're worried about anything at all, don't be. Just let me know. We're here for you 100%. Have a good day and a good weekend.